The VA loan, qualifying the buyer. In contrast to FHA loans, which use two types of qualifying ratios, the U.S. Department of Veterans Affairs, VA, asks lenders to focus on a calculation of residual income along with a debt-to-income ratio. Residual income. Residual income is the amount of net income remaining after deduction of debts, obligations such as utility and phone bills, and monthly shelter expenses to cover family living expenses such as food, healthcare, clothing, and gasoline. The minimum amount of residual income a borrower must have is set forth according to geographic area and number of family members. For example, residual incomes by region for loan amounts of $79,999 or less. Family size Northeast, Midwest, Southwest. $1 $390, $382, $382, $425. $2 $654, $641, $641, $713. $3 $788, $772, $772, $859. $4 $888, $868, $868, $967. $5 $921, $902, $902, $1,004. More than 5 at $75 for each additional member up to a family of 7. Debt to income. The VA's debt-to-income ratio calculates total monthly debt payments, housing expense, installment debts, such as utilities, and other debt, against gross monthly income. Borrowers should come below a 41% ratio to qualify for a VA loan. Lender judgment when qualifying. Both the residual income and the debt-to-income ratio are used as a guide to assessing credit risk, but lenders are not expected to automatically approve or reject a loan on the basis of either calculation. Compensating factors that the lender may consider when qualifying a borrower are similar to those allowed by the FHA, such as excellent credit history, minimal debt, long-term employment, significant liquid assets, large down payment. New loan represents little or no increase in housing expense. High residual income. Low debt-to-income ratio. Tax credits for childcare. Tax benefits of home ownership. Credit scoring. Although compensating factors like those listed above do not offset poor credit, the VA is lenient about credit scores. While the VA hasn't identified a specific minimum credit score requirement, lenders do establish minimum credit score requirements. For many lenders, this minimum score is 620. With a VA loan, which is a much lower score requirement than is needed for conventional mortgages. Qualifying for a VA loan after bankruptcy or foreclosure is also possible, even if the foreclosure was on a previous VA loan. Typically, someone who has gone through a bankruptcy or foreclosure has to wait for 2 years before using a VA loan. This is a significant difference from the waiting requirement for a conventional loan, which is 7 years. The type of bankruptcy makes a difference. Keeping VA borrowers from defaulting. Why is underwriting a VA loan a little different than other loans? The VA strives to make sure that the borrower is going to be able to stay in the home long term. Their underwriting requirements are very careful to leave the borrower with enough money for other needs and discretionary expenses after paying their housing expenses. For example, lenders are asked to consider if the borrower is purchasing a home in a high-income area where they may feel compelled to have higher expenses in an effort to keep up with the Joneses. That extra burden may affect the borrower's ability to qualify for the loan, whereas the same borrower purchasing a similarly priced home in a lower-income area may not incur the same level of expense. The fact is, despite the fact that most VA borrowers make no down payment, VA mortgages default at a lower rate than even prime loans, according to Fannie Mae and Freddie Mac requirements. Eligibility requirements for the VA loan. Not every veteran or current service member will qualify for a VA loan. The applicant must have sufficient credit, income, and a valid certificate of eligibility, COE, to be eligible for a VA guaranteed home loan. A COE is a document provided by the U.S. Department of Veterans Affairs stating whether an individual is eligible for the VA loan, and the dollar amount of eligibility available. The veteran doesn't have to have a COE to get started. Sometimes lenders can obtain one after the veteran has applied. Veterans who wish to order their own COEs may do so on the VA Benefits website, which explains the process to obtain a COE. The individual's length of service or service commitment, duty status, and character of service determine eligibility for specific home loan benefits. Only honorably discharged veterans are eligible, with some exceptions. However, provided they otherwise qualify, active duty, reserves, National Guard, surviving spouses, and even some other government employees can use the VA loan. Service members who don't meet the minimum service requirements may still be eligible if a discharge occurred due to hardship, the government's convenience, a reduction in force, certain medical conditions, or a service-connected disability. Use of property for a VA loan. Property purchased with a VA loan must be for owner occupancy. The loan can be used to buy a home or a condominium unit in a VA-approved project. Build a home. Simultaneously purchase and improve a home. Improve a home, e.g., installing energy-related features. Buy a manufactured home and/or lot. Borrowing limits for a VA loan. The COE is the final word on how much entitlement a veteran has available. The amount of entitlement effectively dictates how much home the veteran can purchase without putting money down. The basic VA entitlement is $36,000. This would be sufficient for a mortgage of up to $144,000. If the mortgage is only $120,000, the VA still only guarantees 1/4 of that, $30,000. That'd leave the veteran with some remaining entitlement, which is called partial entitlement. Because the VA guarantees 1/4 of the total loan amount, a secondary entitlement kicks in if the home value is higher than $144,000, raising the government's repayment pledge to a maximum of $104,250. This level of entitlement means that veterans throughout most of the country can borrow up to $417,000, that's $104,250 x4, without a down payment. The amount the VA will cover depends in part on the area where the property's located. A higher entitlement will be available in more expensive parts of the country. Funding fee. The VA funding fee charged to buyers using the VA loan keeps the program funded. The COE will also be used to determine whether the veteran pays the funding fee, and how much it is. The funding fee may be reduced if the veteran provides a down payment, and it will be waived completely if the veteran has 10% or higher VA disability. Restored and partial entitlement. The entitlement isn't a one-time use deal. Veterans who have used a VA home loan benefit and paid the loan off completely can borrow again under the program, with the same level of entitlement. This is called restoration of entitlement. In fact, veterans may be able to get another VA guaranteed loan, even while still owing on the prior loan, if their entire entitlement amount weren't used in the first loan. This is called partial entitlement. Of course, they would need to qualify for both loans, and a down payment may be required for the second loan. Restoration of entitlement is allowed, though not automatic. The veteran must apply to restore entitlement, under any of the following conditions. The property's been sold and is no longer owned by the veteran, and the loan is paid in full. A qualified veteran buyer assumes the outstanding balance on the loan and agrees to substitute his or her entitlement for the same amount of entitlement the original buyer used to get the loan. The new buyer must qualify for the VA loan with the lender. The borrower has repaid the prior VA home loan in full, but hasn't disposed of the property securing that loan. The entitlement used in connection with that loan may be restored. Example: Bob purchased his home 30 years ago using his VA loan benefit. He's paid it off and still owns the home. He can restore his entitlement and purchase a second home using the VA loan benefit, provided he meets all other qualifications. This one is a one-time only benefit. Benefits of the VA home loan. Owning a home is often a top priority for service members returning home. However, only 1 in 4 veterans has a thorough knowledge of what the VA home loan program offers, and how to take advantage
Section 8,
of it.
Government loans.
Here are a few examples
Unit 1,
of what the VA
Federal
loan
Housing
can mean to
Administration
veterans.
and the mortgage market.
Example: Sheena is a former U.S. Army captain. She's now a single mom with 2 kids and wants to buy her first home. She saved about $5,000 toward her dream of home ownership, which isn't nearly enough for a down payment.
Here's how a VA home loan can help Sheena.
You won't be required to place a down payment, provided the sales price doesn't exceed the appraised value. Interest rates are competitive with those available through conventional financing. She won't have to pay private mortgage insurance, even though her loan-to-value ratio would be far over the 80/20 rule most conventional lenders set. Her closing costs will be low, thanks to VA restrictions on borrower-paid closing costs, and she may be allowed to have some of her closing costs paid by the seller. She can pay off the loan early with no penalty. If she runs into trouble making her payments, the VA might be able to assist her, and will certainly help her avoid foreclosure through counseling or other types of intervention.
Example.
Mark is a veteran who has recently divorced.
He'd like to purchase a condominium and is happy to learn that the VA loan program isn't limited to first-time homebuyers.
In addition, even though he used the VA home loan benefit when he purchased his prior home, that loan was paid off when he sold the house, so he can reuse the benefit with his new condo.
Example.
Walt is a Navy SEAL who's purchasing a home with his family. He has a bit of money set aside, but nowhere near the amount that a conventional loan might require. Unfortunately, the house he and his family had their heart set on appraised at $10,000 less than the sales price, and the seller is unwilling to budge. The VA will only guarantee the lesser of the appraised value or sales price. Luckily, because of his savings, Walt can make up the difference between appraised value and sales price and still get a VA loan.